Good afternoon, Quasar Markets Live. I've got him. You are on fire, Mike. You've been saying the markets are going to go down. You have been right. You got to get, I guess you got to get a Bloomberg terminal, or you got to get a Mike McGlone. I love it. I got Mike here. Mike, tell us a little bit about the markets. What are you seeing now that we've seen this pullback? You've started to see some of the things about Iran. We talked about that. We talked about a lot of the cool things. I had your boy Neil on here, also Nathan Dean, also talking about the president on Tuesday in the State of the Union. My God, you guys have been on fire. What's going on here?
Well, I appreciate you acknowledging when I get it right, because I get a lot wrong. And sometimes you're hot and sometimes you're not. And I've been hot, but it took the pain. So I've been looking for the stock market to correct forever and hasn't yet. But I've been pointing out that one thing that are really happening is we have pretty extreme volatility in the precious metals. That's usually a sign that trickles over the stock market. We have a pretty extreme collapse in cryptocurrencies. Remember, they're the ones that led everything up. That's the tip of the iceberg for risk assets, and they're collapsing. And to me, it's just a matter of time that the stock market has, oh my gosh, a 10% correction. Remember when those days we used to have one of those things? But just imagine when that happens, Steve, that'll be about 25% of GDP. You don't want to talk about a good deflationary force. There it is right now. And that's why my base case this year hasn't even started yet, and that stock market volatility will pick up. S&P 500 is basically unchanged on the year. Nasdaq's down about 2%. But to me, that means that the best performing asset this year will be U.S. Treasury T-bonds, just good old long bonds, and they're up about TLT right now is up about a little bit over 4%. So far, I haven't have a reason to be proven wrong on that, and I'm sure I'll get knocked up a little bit.
And I'd love to knock you up a little bit, because I mean, quite frankly, I want the market to go up just a little bit here. But you were right on the TLTs. There it is. Look, and you see the 10-year now at 3.98%, still slipping. I think a lot of people that want to refi their home or get a mortgage right now or buy a home, they're in a good shape right now.
Yeah, I think they're getting in better shape, but I think it's a matter of time. This to me is just getting started. This is so early days. And I like to point out the stock market hasn't even broken. It hasn't done anything. I don't know if I can share a screen. I can just show you an example. So here's just the year so far. This is Bitcoin's breaking down. It's hovering on that 60 level. This is the 10-year note you just mentioned. It just broke below 4%. It's a new low for the year. It's approaching the low back from October. And then this is the stalwart. This is the S&P 500. It's just stuck in a nothing range for 6 months now, and it's not doing anything. So that's my point, is when that rolls over, now it could make new highs first, but when that rolls over, that just accelerates the T-bond trade. I think it actually hits everything, including gold, because gold is so stretched. But this is the bottom line. You ain't say nothing yet. This is nothing so far. This is a Friday. It's end of the month. S&P 500 is down less than 1%. You see that? That's nothing so far. It's just stuck in a range. But that's my point. At some point, that'll probably have a correction. And then the biggest trade of a lifetime might kick in. That's why I'm starting out slowly. So I still look at, any rallies in Bitcoin around 74,000 is probably a potential prudent short. Any bounces in T-bond yields near 5% is probably a prudent buy. Now, right now, the yield on the T-bond is 463. So I'm looking at that TLT. Who knows what levels, but dips in that market. And copper, even copper's right. It just tested 6 today. I think it's a prudent short to sell around 6. Even silver around 100. Partly because the key thing is, Steve, when this kicks in, I didn't say if, at some point we're going to have normalization. When this kicks in, the dominoes tumble. And that to me is what I think we're starting now. But again, this is just nothing. It hasn't, like I said, this hasn't.
It's interesting that you put Bitcoin and bonds together like that.
Yeah. I have to. It's the same chart, because it's something I've been noticing for a while. So the tip of the iceberg for speculative excesses started with Bitcoin, was 1 in 2009, and now there's 35 million of them. So that's a lot of speculative excess in cryptocurrencies. 35 million cryptocurrencies. Obviously, we know Bitcoin supposedly has limited supply, but it led all the way up. It led this massive wealth creation, which created the wealth effect and inflation, but now it's leading the way down. And it's one thing I really noticed last year. The long bond peaked at 515, right around when the Bitcoin peaked, when Bitcoin peaked just above 120. And that was 515. Right now it's 463. And as we're heading lower, bond yields are heading lower. So I think that the bond yield, Bitcoin's leading that way to the inflation deflation. And we all know what that means. Once you get inflation, you always deflate. Now it's happening in China. It's happening in most commodities, most notably like natural gas. Crude oil's bouncing a little bit, crude oil, grains. And I think it's just a matter of time it trickles over to the stock market. But the tip of the iceberg for risk assets is cryptos and Bitcoin. And the tip of that was MicroStrategy, and that showed you its breakdown last year.
Yeah, and when you put all the commodities together, it just seems like there's something strange going on in the futures markets. Does you feel like the volume is picking up a little bit in the futures markets?
Oh, yeah. Well, I think it's the time of year we get started. We're supposed to get started. It's one thing I'll point out is this is just a measure of my key base case for this year. I'm showing a long-term chart. This is NASDAQ 180-day volatility. It's just bottoming from the lowest in 8 years. You don't want to be short volatility here, and you don't want to be buying risk assets until that mean reverts. Cryptos are risk assets. When people keep calling for a dip, I'm like, at least wait for volatility to bounce. So that's what's just getting started. In the meantime, to me, that's the key thing that's happening is volatility is just too low for a sustained rally in the stock. I mean, it's one of those indications you're supposed to pull back. But the key thing I also want to point out is we've just dropped to 1.31 ounces of gold per one S&P 500. On the way down, that's the lowest since November of 2008. This is the breakdown I show you here because that was right after Lehman. This is a pretty significant breakdown. And then I just show you one reason why that I'm just looking for a little bit of reversion. This is stock market cap to GDP, 2.3 times. That's the most in 100 years. See that combination? Lowest volatility in 8 years, high stock market cap volatility in 100 years, stock market breaking down versus gold breaking out. This is just a recipe for volatility. And the key thing is happening. We're getting that significant volatility in cryptos. In commodities, we're getting some volatility. The grains, nothing at all. But we're getting zero, the lowest volatility stock market ever. I'm just expecting that volatility to trickle up to the stock market.
Yeah, and I love the fact that you're putting these correlations together because it seems that a lot of people just can't figure out these correlations. Why is the market going up? Why is the market going down? We've had 6 solid weeks of NASDAQ really kind of pulling back a little bit. And you look at what else is going on? Is the dollar getting involved here? Is gold getting involved here? So what are the other commodities or futures that you're looking at that's also, I don't know, maybe pretending to be part of this market here?
Oh, I love how you said that, Steve. You're such a trader. Pretending to be part of the market. I start with.
Can't help it.
I have to start with copper. I'm not going to show you a chart on copper because it'll take me a while to pull it up. But if you overlay copper with the S&P 500, just take the S&P 500, lop off, 3 zeros. It's the same dollar price of copper for the last 10 years, except lately, last few years, stock market's taken off and copper's catching up. So that's why I view copper. The high this year is high close around 625. Right now, it's right below $6. To me, when we get the next correction in the stock market, say 10%, copper's going to drop 20%. It's just the way it is. It's an industrial metal. It's very sensitive to the stock market and very sensitive to global economies. So to me, that's that's one of the key ones I'm watching. And silver too. Silver had that little rush above 100, and I view the silver is now an industrial metal. And I think for silver to stay up, the stock market has to stay up. And I look at that as it's so stretched historically. Well, that's potentially a prudent short above 100. And unfortunately, I can't say prudent short next to the word gold yet, but I'm still so worried. Gold is so stretched. A little bit of global detente can get gold right back down to 4,000. But also stock market going down might hit stops because everything is just so expensive. And most notably, gold is. So here's the one thing about gold. It's switched over from a store value that traded around volatility around 15%. And now the volatility 180 days running around 30%. That's 2 times the S&P 500. That's the highest in 20 years. That's not a store value. That's a speculative asset that's getting stretched.
Yeah. And you see NVIDIA giving these amazing 8% revenue jumps, earnings releases. They're telling you that we need commodities. We need the lithium. We need these things. We need silver. We need all these things. And it seems that around the world, we're not really picking up on that too much. And it even seems like companies are even changing their processes and how they're doing things. Like Apple is maybe looking to buy back a lot of old phones to get some of that processes back in the metals. Where would you start to put some buying going on, Tim? Where would you start to put some ideas of, like, say, lithium or you said silver. I understand that, but I mean, there's other metals. There's other. I mean, I saw earlier palladium, right, was an issue there. What other things are you actually watching that maybe the actual average trader is not actually looking at?
So then I'll go back to my share screen. I have to show you something the average trader is not looking at. If you weren't on top of the metals, most notably the precious metals, the last 3 years, this chart shows it's not a time to buy virtually any metals. This is the Bloomberg All Metals Index. It exists because I last asked the index team to create it 10 years ago, partly because metals are the best place to invest, historically have the best return.
That.
Yeah, but this is, you take the metals, this is the metals, the All Metals Index, divided by the Bloomberg All Commodities Total Return Index. You're going back almost 30 years. It's the most expensive ever. It's very similar to that peak in 2020. This is when gold peaked around $2,000 an ounce, and it took until 2024 to take out that high. So any of the metals, if you haven't been long them already, history will suggest buying them now is very poor risk reward, and there's never a problem with being able to say when you've been on top of a bull market to say take profits. So I have no bullish inclination in any metals. And for dips, you go ahead. Sorry.
Yeah, but if you look at this, Mike, what those tops and obviously linear regression. What was special about those times that maybe could be an allegory to today?
Well, that's the key thing. This is the most significant. This was the biggest money pumping history in the back of COVID. Remember, metals did fine, not so much all of them, but gold. This is mostly gold doing fine. The rest of the commodities having a problem. Now we have all metals doing fine versus broad commodities. So the bottom is, relative to other commodities, metals are the most expensive in history. Now, I'm bullish the metals, but I'm not buying them here. And that's my point. So let's talk about some levels. I think it's very likely that we're going to get on the year. Silver will have a down year, just like it did after 1980, and maybe even gold. So the first key support I think I'm looking for silver is 50. I don't think it stays much above $100 an ounce, and even copper. I think copper's putting in a good peak around 6. Now it's in a bull market. I think it easily drops to 450 or so, and maybe you can look to reset longs in a bull market. But the prerequisite for all the metals that go up, most notably, and maybe less so gold, is the stock market has to go up because everything's so stretched and so connected now.
And with $8.5 trillion on the sidelines in the stock market, all this money that's gone into the metals, so you think the money will come out of the metals soon and back into the stock market then?
No, so not so much that. So the key thing about the 8 trillion, I don't know so much about that number. That makes sense, but that was a great trade. But the difference is stock market is an income producing entity index. Typically indices have a survivor bias that tracks human ingenuity and innovation and ability to make profits. That should go up over time. The metals are the opposite. They're auto-correlated assets. Most notably the precious, I'm seeing less so the precious metals, most notably things like copper and silver. They go down because they went up. That's their history. And that's the problem with like copper right now. Copper just got way too expensive. Long term, it's bullish. But you see inventories growing all around the world, and most notably in the US and London and Chinese exchanges. And you see waning demand from China. Now, we all get the electrification, but the point is once markets go up, there's always a good reason. But remember autocorrelation. Commodities go down because they went up, and they just went up too much. So the correlation I'm using is, to me, metals look very much like cryptos did last year. Yep. They had a great rally. Everybody was bullish, and people like me were called idiots for saying time to get out. And look what happened. So now we're going to do, I fully expect that type of scenario in metals next year. And that's what all of them. I mean, I've been bullish, most notably precious, particularly gold, less so silver. But the basket of precious metals, most notably platinum, they all look great a year ago, but now they've just gone up too much. And that's just the discipline of trading. You're supposed to be lightening up and taking profits when markets get out of hand. So here's the thing I'll end with. You have supply, demand, and price on one model. And people talk about all these supply and demand things that are making deficits, but everything just changed. When you get the sharpest, highest velocity rally in price, it shifts the model. Highest velocity price in almost 50 years, it'll shift that model, particularly bring on that supply, bring on thrifting, which is a word we're going to hear here in silver next year, and put in enduring peaks. So I'm just pointing out the facts of history, and it's also a good problem when you've been overly bullish these assets forever, to be able to say take profits.
All right. I live here in Florida, Mike. Obviously, the weather has been a little cold thanks to you guys up north. And orange juice, the big O FCOJ. Where are we with that? I know that the markets here in Florida don't really pay attention to the orange juice markets as much. Although as we know, we go back long enough into the breakfast trays, we used to call it, right? Yeah, there we go. I like that institutional side. Where are you thinking about with the softs here?
So I like to use orange juice and cocoa as my best example of markets go down because they went up. Orange juice and cocoa were the worst performing commodities last year, down around 50% because they were the best performing commodities the year before. See what happens? That's how much almost always works. If you're not on it before the breakout, buying it after it goes up typically doesn't work. But when you mentioned cold weather, I want to tilt over a little bit to natural gas because I don't write much about orange juice anymore, partly because no one cares. It's not a major commodity, but we've had the coldest 2 years of winters, successive winters in maybe 20 years, yet natural gas has collapsed. Right now, the front contract is $2.80. The high was $7. Now, that was obviously the Jan and Feb contracts, but now we're back into April and summer contracts. But even the January for next year, 27, is trading around 460 or so. It just can't stay above 5. And that's the key thing to remember as we enter an election season where the president of the world's largest energy producer and a net exporter of natural gas and crude oil wants energy prices lower. He's going to get them. So I look at natural gas as it's probably going to stay weak. It's typically trades between 5 and 2. Right now it's 285. So it's got to put it low. But the most significant one in that is crude oil. Crude oil's bid right around on 67. That's right just above last year's mean. We're expecting potential fireworks out of Iran. Who knows what's going to happen? But I tell you what's happening is I know every producer in the U.S. is looking at that price and saying, yeah, sell some forward in those backs, lock in some of those prices, bring on some more supply, keep us alive another year. And they're saying, thank you very much. It's going to just accelerate the bear market. So at some point, when we see what's going to happen with Iran, unless there's a major curtailment of supply, even out of the Middle East, I think that bear market's going to resume, which is part of that deflationary force you see. I showed you in bond yields, in Bitcoin, mentioned it in natural gas, potential with copper rolling over, potentially peaking silver. These markets are just, there's bear markets that are potentially rolled over and bull markets that potentially reach peaks in metals.
Yeah, and I love this, Mike. And I'm going to ask everybody here, if you don't do me a favor, click on that link I just put out there to give some love on Twitter to Mike McGlone, because I'm telling you right now, he's spitting out diamonds for you folks. If you didn't, he's been dead on when it comes to the markets, and he understands it. I mean, we've been doing this for so long, Mike, you and I have been, and giving back that knowledge is amazing. We appreciate you, obviously, and appreciate Bloomberg and all the things that you guys have been doing for the markets. And so I'll leave it at that. Last words there, Mike, before I let you go.
This is a best trading opportunity year, I think, of a lifetime. Be nimble. Don't be aggressive buying risk assets, and trade the volatility. And I think it's just getting started.
TLT still hot?
Oh yeah, well I think that's going to be the best performing major asset this year. Last year I got lucky, got gold right. Year before I've been lucky for a little while, got Bitcoin. I jumped off that horse too early. I jumped off gold too early. It's still going up. And TLT, I've been bullish for way too long. People would know that, but now it's time, I think.
And if you know me, folks, I don't believe in hope and luck in the markets. I believe in smart people, and I believe in Mike McGlone. Thanks for so much, Quasar Markets Live for Bloomberg. We love it, and we'll see you right back here on Friday next week, Mike.
Thanks, Steve. Thanks for having me.